300 million operating, just investing in crypto across the board. So a lot of our portfolio includes things in crypto AI, infrastructure. We've done investments like Privy, Ritual, and so overall we're relatively excited, always looking at things to deploy in. From my background, I've gotten this space a lot via engineering, worked at Starknet, Arush, and overall I'm very passionate around liquidity and capital markets in general. Yeah, happy to kind of pass it off to the rest of the panelists here to look forward to what they have to say today. Oh, yeah, to look forward to what they have to say and also hear more about what everyone's doing. So I'd love to start with you.
Hi.
It's all dead.
Hello? Hello. Okay. Hi, I'm Julia. I am COO and co-founder of Caladan. We're one of the largest independent crypto native market makers. We trade on exchange, we trade on chain, we provide liquidity via API and also via OTC. Headquartered in Singapore, but we also have an office in the United States in New York, and very happy to be here today.
Awesome. Hi everyone, I'm Ryan. I'm the co-founder and COO of Genius. We're a trading terminal, but more so we're just building a lot of DeFi products, trying to build centralized exchanges on chain. We're headquartered in New York, but our team is basically here in Dubai. So.
Downey, head of product strategy at Talos, leading capital markets technology provider for digital assets, front, middle, back office, so everything from liquidity all the way to sort of settlements, and based out of New York, and very happy to be here, and thank you for the invitation.
Arush, Zhou from Alpaca. We're an API-first brokerage. We're a self-clearing member at the DTCC, various licenses around the world. We power a lot of traditional securities broker-dealers, as well as we have a crypto exchange and all of the US money service business licenses. I run digital assets, resolve crypto spot and derivatives, and all tokenization efforts. So, yeah.
Very cool. It seems like a lot of us are headquartered in New York, or at least have some headquarters there, so that's very awesome to hear. Yeah, by way of, I guess, continuing on with today's topic of conversation, capital liquidity, definitely super interested to dive in. I think like a key point that I've been thinking a lot about is what liquidity kind of means across the board here. Also, interestingly enough, I think a lot of us on the panel interact with different markets, some that are more deep, some that are maybe not as deep, maybe more shallow. So I'm actually very curious to kind of understand what liquidity for each of you all mean, as well as in general, like what focus of area that you guys are all interacting with on a day-to-day basis.
I think my definition would be very simple. Liquidity is, can you actually execute at the price you think you can? Like when you see a number on screen and then you actually try to execute, perhaps at size, are you actually able to do that? If you can, there's liquidity, and if you can't, there isn't.
I would say definitionally align with that. I would say we're a terminal, and so depending on how the market's going, we deal with a lot of speculative assets, which the answer to that question then is typically not.
I guess two angles. Something in, and adding on the definitions rather than repeating. First of all, something that in crypto and digital assets has to be stitched together from many, many different sources to actually be able to trade at size. So no one place where you can execute massive block trades without moving the market, and that would be the second angle. I think about it also just in terms of like market impact models, being able to estimate at a given time under given scenarios, how much are you going to move the market when you try to do that really big trade you want to do. So it's the quant side of things as well.
Could you repeat the question, please?
Yeah, I think we were just talking in general, more broadly, what liquidity kind of means for you and the company that you run.
Yeah, so for Alpaca, this is actually one of the problems we solve is bridging liquidity across from TradFi to the tokenized markets. So as I understand it, it's the only product in the market today that does this. It's called the Instant Tokenization Network. The way it works is market makers, let's say they want to offer Tesla X, right? The X stocks version of Tesla. And on the weekend, Elon tweets something and they run out of Tesla X to offer. So they need to mint new Tesla X on the weekend. How do they do that? They come to Alpaca. We offer them a locate for Tesla. They go short Tesla, traditional Tesla, and they can mint Tesla X through the ITN network. And so they can actually bring liquidity over from TradFi into the crypto markets. And that works instantly 24/7. And the same way it works in reverse too. So they can redeem the Tesla X and get the share back. So we provide this for various different flavors of token, including the DTCC's token coming soon. So that's what depth, I think, means to me and to us at Alpaca.
Very interesting, and maybe double clicking there, for what you're building on the tokenization network, is the assumption here that a lot of it relies on being able to source inventory from like certain companies to be able to tokenize?
So when you say sourcing inventory, it's the liquidity providers that are customers of Alpaca. They're the ones who have the inventory. So they're the ones deploying balance sheet to make for the tokens. Now they may be pulling their liquidity from the TradFi, whoever's, on NASDAQ, their counterparties on NASDAQ or whatever. But we provide the rails so that everything can flow smoothly.
Very cool, very cool. And then I guess jumping back, I was also very curious, Julia, on your opinion. I know you guys are doing OTC and obviously market making. I think one interesting point has been mostly within like on-chain and the sex world. It seems as though there's a lot of adversity here with respect to having liquidity and being listed on a sex. I think like one case in point is Collector Crypt and cards, which has been doing very phenomenally recently, but facing I think liquidity issues with respect to being like a 500 million FTB coin, but only had like 1 mil of liquidity to actually trade. So I'm curious if you think like, I'm curious what your thoughts are in general on this like sex listing land and also like on-chain assets and like pools and liquidity there, because it is much, much less deep.
Yeah, I think if we're being honest with ourselves, we all know that a lot of the reported volumes that we see on centralized exchanges are not actually real, right? I think research says puts it somewhere between 60 to 80% of the volume that you see is actually just like the exchanges wash trading. So in terms of where we see actual liquidity, Finery Markets put out a report late last year that said that for institutions who are looking to execute, half of them prefer to go OTC, right? And with OTC, it is like there's real liquidity there to be able to execute, and that is what is driving the demand. It's because, if you're executing on screen, it's not always real.
Got it, I see. Okay, very interesting. I guess jumping around across the board, I'm also curious to hear from maybe like a more terminal on-chain perspective. In general, like, I'm curious, Ryan, what has kind of changed as you've built out Genius with respect to the market and how liquidity lives? How have you adapted? Are you onboarding different, say, like material venues and different material tools, like now having prediction markets or looking at perp dexes or mainly only focusing on spot exchange on-chain? I'm curious to kind of understand with the growth of liquidity in general, like what's kind of adapted for you guys as a terminal?
Yeah, from a liquidity perspective, I think for us, it's more around like the chains themselves. So like we've had the fun of from the get-go, we've always been like cross-chain, and so we've got to see like the rotation of capital from Solana to then BNB chain, and as of more recently like ETH. So like from a terminals perspective, like watching the liquidity flow in that way is interesting. I think for us generally, we're like super bullish on prop AMMs, and like being able to provide, at least for the majors and hopefully soon Genius token, a really cool prop AMM experience that we're working with Argonia on, and they're kind of like working on like a single kind of pool instead of like having to provide inventory for every individual pair. So I would say, for us it's mostly obviously the prop AMM, but then more or less just watching the flow and the rotation of capital between chains. That's kind of where we see the fragmentation. Yeah.
Okay. Very cool. Very cool. Awesome. Well, I guess switching gears and maybe addressing more of the larger group. Obviously, overall, with where crypto's headed, a lot more capital has come on chain, that of which has been largely contributed from institutions. And you guys are all in different lines of businesses, so I'm very curious in general for each one of you how specifically, number one, if you guys do see the change and do feel the impact of more liquidity coming from institutions? And then number two, how does that impact kind of like the business that you're running?
So how does more institutions coming online affect our business? Well, we face a lot of institutions, so we specialize in bringing regulated environment, like bring crypto to regulated environments. So for us, it is, our bread and butter. We spend a lot of money on audits and licensing and compliance teams. So we think, there's a reason why. This is because we're bringing safety to the market. It's about maintaining market integrity. And I trade on dexes unregulated, right? But I do get my face ripped off from time to time because of the, especially when the weekend oil markets first came out, pre the new bands that they released. The version 1 of the bands, like if you managed to buy oil and it was like limit up, you can't get out of that position. So you couldn't actually sell it. And then the Monday, even though it was theoretically a 24/7 market, when the Monday Open hit, your market sell order would trigger at God knows what price, right? So, these are the types of things that, you need regulated markets to protect you against. You can just get into situations where you were not intending to lose money, right? So, yeah.
I would say there's kind of two phases of it. One was kind of the rise of the crypto ETFs, where we saw that wave coming in. A huge amount of liquidity from crypto ETPs globally goes through Talos infrastructure. So we saw that kind of wave coming in, and we've even seen that in terms of its impact in liquidity. Like the changes in the profile of when during the day you can trade the most is very much affected by the ETFs. Wave 2, I'm going to be a little bit more colorful about it, although I would kind of echo everything Arush said a moment ago, in that we face institutions, SOC 2, Type 2, all of that. 6 months ago was probably the oh shit moment for a lot of really large institutions of like, we're potentially behind the 8 ball on tokenization, behind the 8 ball on things, say, post-DTCC announcement, which you alluded to, just because I think there's a degree of recognition that they are slow moving. So that doesn't mean they're doing something next month. It means they're thinking to themselves, it takes 18 to 24 months to get something done around here. And oh my gosh, this is going to be really big 18 to 24 months from now, and I'm behind. So we've very much seen that in terms of inbound, in terms of the level and seriousness and urgency of interest, really just in the last half year.
I don't have a great answer for this because we don't deal with institutions primarily. I would say, I don't have a good answer. I'm not going to bullshit.
Yeah. I think about this in terms of two angles. The first one is, I think, certainly the institutions are coming on board. The New York Stock Exchange is launching a tokenized blockchain in Q3. NASDAQ is going 23/5, right? I think what they're really focused on right now is just from the pure business perspective, more trading hours means more trading fees, right? So right now, the US equities market trades about 32 hours a week, I think. If you expand that to 168, right, they're like, oh, we can earn 5 times as many fees. It's amazing. But what they're not thinking about is the composability, which has always been, one of the primary features of DeFi, right? On-chain, your tokenized NVIDIA or Tesla doesn't just sit in your account. It can be used as collateral for lending. It can be used to mint stables. It can be, you can stake it, right? There's all kinds of things that you can do with it. And that part, I feel like TradFi hasn't quite wrapped its head around how it's going to do that. The other thing that I think is really important to pay attention to with institutions coming on board is how they're going to deal with cross-chain settlement. Right now, I think that's a big problem. It's like the FX markets pre-CLS when everybody had to settle every fiat individually. And, without central clearing, you really run a lot of counterparty risk.
So I think that the main challenge, as you alluded to, there's a lot of capital coming in from financial institutions. I don't think capital or regulatory is our blocker anymore. I think it's really like, how are we going to be able to handle this from an operational perspective?
Yeah, just to add one thing, there's one other aspect to that, which is collateral management.
Yeah.
So the very first time someone takes a tokenized US Treasury, which will very shortly be available, and says, I want to post this, if you do not have the systems that can manage that, like that one bond is a really, really big problem for you, even if the vast majority is still traditional. So we're in this very awkward teenage moment where like a small portion is represented of growing, and thus you have to like live in both of those worlds. So I think that's another element people are kind of waking up to of, oh, we need to manage this now.
Julia mentioned something really important. If you talk to a lot of crypto people, they generally will not understand what the word clearing means, because all crypto spot trades are, there's no concept of margin or post-trade settlement, so there's nothing to clear. So when you bring traditional assets like that need that T+1 post-trade settlement, and you're tokenizing the asset, and now you need to think about how you do centralized clearing, that concept doesn't exist yet. There's no clearing agency that exists today that clears share-to-token swaps in the same way that Alpaca does, actually.
So wouldn't it be nice to have a tokenized clearing broker?
Yeah. I mean, essentially, that's what the industry is going to have to solve. If you have, let's imagine you have a broker A needs to, by the end of the day, settle some shares to broker B. But that broker B also executed trades throughout the day and needs to sell to broker C. So if in a T+1 world, you have A to B takes 1 day, and then B to C takes another day, so that would take 2 days. That's in the traditional world with no centralized clearing, like bilateral clearing. And so you need centralized clearing to actually have the settlement go from A to C in 1 day, because it's cleared through CNS today. We don't have that in the tokenized asset world today. And in fact, if you talk to a lot of like NYSE, NASDAQ, even DTCC, they haven't been able to like formulate a strategy yet that they don't even know this problem exists yet. They're still at step 1. And so I feel like a lot of the institutions just don't yet know what they're doing.
There's actually a name for this, right? In the pre-CLS FX markets, it was called like Herstatt risk, which is where your counterparty doesn't pay you. And that is a very, very real problem that people are facing now as they're moving on to tokenized rails.
Very interesting. And then have you guys thought through, like, respectively, like what solutions or what angles you want to approach to kind of solve this sort of fragmentation and these issues?
So ITN, Instant Tokenization Network from Alpaca, does solve this issue. It's going to require, I think it's emerging in the same way that the NSCC emerged in the TradFi world. Because originally, without centralized clearing, brokers would all settle bilaterally with each other. And obviously that model doesn't scale because of the reason I just described about A to C. So the NSCC formed as a member-owned consortium, and it was just necessary for the market to function. So I think that's what's probably going to happen for these tokenized assets too, like a consortium, a member-owned consortium.
And then on the technology side, the first part of it's a normalization problem. If you're dealing, we on the Coinmetrics side, 39 different blockchain networks that we connect to, and then 80 different liquidity networks, custodians, et cetera. Like, what is the value of having that? One way of accessing it, so you don't have to directly write to all of those. So there is I think a place for technology platforms to help stitch that together. I don't know if that lasts forever, honestly. I think so long as we have multi-chain and solving for that problem, there's gonna have to be something that stitches things together, and we don't seem to be heading to a single platform world, nor do I necessarily think that we should. So I think that will be there for a long time. But I think so long as you have that, you have to have some way of sort of going one to many, and that's the element that we've kind of gone after.
I mean, as I mentioned before, I don't have strong opinions on this, but I would agree with that in regards to like there will always be many chains that have a lot of liquidity, and you'll need to solve for that problem, especially as incentives exist in crypto. It's like people love incentives, so.
I think our view is just that crypto is inherently fragmented. It is a feature of this space, right, that's driven in part by regulatory differences in the past, like different governments can't even agree on what exactly a digital asset is, what constitutes a digital asset, right? They can't decide on, what framework is supposed to govern it. Different blockchains also drive that, right? I think in the last few years you saw this huge proliferation of like L1s, L2s, everybody's trying to build better mousetrap, more throughput, faster, et cetera. And that definitely drives that as well. And I think the way we think of it is if you look at some TradFi markets that also have fragmentation as a feature, like FX, again, you have this liquidity spreads out over all of these different venues, and then there's an aggregation layer as well that brings it back. I think as a liquidity provider, we are, part of that aggregation layer, right? Our value add to the markets is exactly that we have gone through the brain damage of dealing with all of these different APIs, all of these different chains, being able to bridge it, and being able to offer it through one single API. We've also dealt with the operational hassle of settling across all of these different chains, different assets, et cetera, different fiats as well. And that is like, that's a thing that the market actually needs, otherwise we wouldn't exist, right?
Totally. I think definitely one thing we all agree on here is that fragmentation is like a very big issue that we foresee and have seen throughout crypto. It's an interesting point. I know today there was just an announcement as well. So like more on the crypto side, I think it's really interesting because today, DFlow just got acquired by MoonPay. I think I don't know if you guys agree with this or not, but personally I feel like fragmentation on-chain for liquidity has been addressed and maybe not fully solved, but we do have like quite sufficient solutions these days, whether it's via intent models and routing systems like Relay, or we have different swap aggregators or like prop AMMs. So I feel like it almost feels as though we, and also like in general, the stratification across like multiple different L1s and multiple L2s, I don't think we're seeing as many new L1s come out or as many L2s come out, especially after kind of like what was super excited with like Mega ETH and Monad. Like I don't think we are seeing as much hype or as much, for lack of a better word, like excitement around a lot of these new layers coming out. And so personally, I do feel as though the problem has shifted a lot less against aggregating or routing liquidity across different blockchains and different block spaces. It feels as though the issue is more so drifting towards where like institutional fragmentation lies, and specifically, especially with like tokenized equities, I think there's probably a whole world of like fragmentation that is way more different than what we see on chain. So like I guess the question now is, especially for like the crypto natives or the people that maybe don't understand what clearing is or are just like very native only to like on-chain specificities, how much more difficult is it to solve this fragmentation problem that institutional capital and institutional solutions are going to bring to like crypto in general?
So I mean, you brought up, I'm sure you're going to touch on some elements of this as well. So something that's kind of worth calling on, I think came up in an earlier panel as well. The way I've often thought about things through a risk lens, that like way in the back there's this idea that you have an exposure to Tesla. And then there's all the different ways that you could get exposed to Tesla that have different elements. They have, maybe it was in an SPV and you've got some credit risk in that. Maybe it's a different representation. Maybe it's on a particular L2 that is giving you something that, sorry to say this about a technology, is giving you like counterparty risk of some form. Only your counterparty is this decentralized network rather than a company or an SPV or whatever. Maybe, God forbid, you've looped it like 15 different times and you've got a whole stack of smart contract risk on top of that. But at the end of the day, you still need to recognize that it's Tesla. And it maybe has spreads on top of it, but it is still Tesla. And so I think one of the interesting things I think we may see, and maybe having some of the liquidity providers step in, is saying like, fundamentally, I'm comfortable with managing that risk. Like, I'm okay with having that exposure over the next 12 hours, whatever its representation is, and I'll deal with the various forms of it. But I'll give you a price that's based on the different ways that it's represented. Like, I think this is, an earlier panelist said this as well, these things are not built into the price yet. And this is actually a value I think that the LPs provide, is actually pricing that risk of the different variants of the same thing. There are technical issues as well around reference data, like we have like no unified way of saying these are all the same thing or related to the same thing, but that's maybe something a consortium can help solve, or standards bodies.
Yeah, you have the same thing in TradFi too. Like, you have 2x levered ETFs that are additional counterparty risk to the underlying, right, than to just buying the underlying. And so they blow up all the time. And so I think this concept already exists in TradFi. I think it will still exist. These SPV wrappers are not necessarily a bad thing. They do exist in TradFi. But the complexity of having multiple chains, multiple settlement chains, like and then you also have to deal with the TradFi complexity. So it's, to answer your original question, the complexity is multiplied. The people that play in between TradFi and tokenized worlds are all going to have massive operational changes. They need to now support 24/7 trading and settlement. They need to support US dollar settlement, like banking over the weekend. So yeah, I think this is going to be a huge. That's why they're all slow. That's why they're all behind, right? Because no one's ready.
I think one of the things that we get asked for a lot right now is, being able to provide liquidity for tokenized RWAs on nights and weekends, because that is a very, very difficult problem, right? Like, when there's no reference price on the underlying, as he was saying, there's Tesla stock, for example, there's so many representations of it now, not only in the TradFi wrappers, but also derivatives on the TradFi wrappers. In the tokenized world, there's spot, again, there's derivatives. Now there's prediction markets, so you can bet on not only the price of Tesla, but also, what the next earnings announcement is going to be, right? So between TradFi, tokenized rails, and prediction markets, there's now just a plethora of different ways that you can express a view on, the underlying, and it is a very difficult. I think right now, if you look at tokenized, Tesla, for example, if you look at it across different chains, there is a 1 to 4% like price difference, right? And there's a reason for that.
That will close soon.
Yes, agreed.
And I will say this is also something that's not all that new, right? I mean, this is the fundamental of arbitrage. You get two things highly correlated but slightly different, and those arbs will close. But the way that will happen is getting connectivity between those markets. It's just we have even more variations of how it's expressed. But I think quant traders are going to have a field day with this.
There are instances where the arbs cannot close structurally. Like, if you ask the HFTs, there are some markets that they will just not get involved in, because after they do a little bit of research, they realize that there's a spread, like there's an arb there, and we can't close it because there's a structural cost. And I think some of the tokenized asset issuers are starting to realize that the model that they're introducing is introducing structural costs and structural friction that cannot be closed. Like, contrary to what most people believe, the SPV model actually is a way better model when it comes to liquidity, because there's no cost or like friction to go between the share and the token. But if you're looking at like the Galaxy model, where they've issued the token through Superstate on Solana, you can't go between the token and the Galaxy share unless you call up the transfer agent or you call up your broker, and there's a 3-day registration process to move the token back to the share and vice versa. So that's like an example of a structural inefficiency that can't be closed, and those prices will always differ. And I don't think it's in anyone's interest to have the same QSIP trade with two different pools of liquidity and two different prices. So eventually, this is an example of when I said earlier, like, some of these institutions don't know what they're doing. They didn't think like 2-3 steps ahead. They're still at step 1, and now they're realizing, oh shit, that was the wrong step forward. So we get a lot of calls from the guys that are doing the wrong model and saying, how do we bring this token back into the TradFi system? Because we just realized we lost SIPC insurance, we lost the ability to trade, the customers lost their margin loan facility. You know, they want to go back to the broker-dealer system. So it's very interesting.
That is very interesting. And then do you think that there is like, I mean, you probably have opinions on this, but like, what would you say is like the more right forward model here? And then like, are SPVs then like still worth to consider as like a bad date solution?
Yeah, SPVs is providing something very interesting for TradFi, which is weekend price discovery, and the perp markets too. And I think that's how this 24/7 trading for TradFi is going to be bootstrapped. And eventually, when the US dollar rails go 24/7, that's a huge unlock for like the traditional exchanges to enable it. Yeah, so the SPV model is a good plug. DTCC's model is very similar to an SPV model. It's just that your counterparty is DTC, and so they take the share, they lock it, and they issue a token backed by it.
Just wanted to add that problem you mentioned, just to call it out. That gap risk across the weekend. This is something for the banks, for the trading desks. Like, they don't necessarily have great vehicles for closing it. So I think it's a really good point. Like, when they have that vehicle of actually closing that gap and not having this big jump on Monday morning when the market opens, they will start using it for hedging. And that is going to start introducing more liquidity at that time that, you know, information is coming in that it's not available in the markets. I mean, I think it's fascinating, this sort of signaling that's starting to come out of the digital asset markets, that actually the traditional markets are kind of scrambling to catch up with. This gives them a way to actually leverage that as needed.
Very interesting. I almost wonder too, like to your point, and this is probably just looking at the data, but even for existing venues right now for like overnight weekend markets, how much of like the volume and the open interest stays just within that gap as opposed to like rolling over? That's probably an interesting metric to look at. But yeah, and I guess probably a question to loop you in as well, Ryan. I'm curious, like for what you guys are building, have you considered integrations with certain tokenized equities or different assets in this field?
Yeah, that's what I was gonna say. To close all these guys out, it's like I'm grateful that they're all working on these problems, such that we can distribute them to our users all over the world. Yeah, we have an integration with XStocks, looking at doing Ondo Finance as well, and we've looked at like some of the pre-market stuff as well. It's just ultimately the way that we view it is just like what is the risk for our users who have funds on platform, and how can we make sure that everything will settle accordingly, and like we're not liable for any sort of like loss outside of like loss that's associated with like reasonable risk.
Totally. Very cool to hear.
Both of those are customers of Alpaca, by the way, XStocks and Ondo. It's cool. It's kind of interesting because we can probably publish a live feed of their reserves that are backing the token, because you can see on-chain their liabilities, right, of the token, but you can't really see their assets. So only Alpaca can see it right now. That's something that your customers might be interested in seeing.
So the flow, it comes down.
Awesome. As we wrap up, we'd love to kind of go down the line and let each speaker on the panel here today maybe say a last word in regards to what's exciting for them, maybe a call to action, their thoughts in general on this topic in general. But yeah, happy to kind of go down the line.
Sorry, I don't know what to say. Why don't you guys start?
Thanks, Tommy.
The thing that we've a number of us in the space for a long time have been excited about, in some cases motivated us to like get in the space, is finally happening. That one day every asset will be a digital asset. Like, this is actually like starting to come into view. And as I said earlier, like this is actually going to be really hard. This transition period before we kind of get that unification is going to be very, very awkward. But you can see that the promise is kind of within reach, and I think we've kind of had a jump forward, like an acceleration over the last half year to a year, faster than I personally had expected. So I'm excited about that.
I was just going to say, I think things are going to move a lot quicker than people realize.
Now that I've gathered my thoughts, I think a couple of years ago, post FTX, and people were asking me what it would take for crypto to kind of get back on its feet. And at the time, I'd said, I think we need genuine use cases and we need regulatory clarity, right? And now we very much have both of those things. And frankly, less time than I thought it was going to take. So I think I think things are going to move very quickly from here on.
Awesome. Well, thank you very much. Would love to kind of say some thanks and give some applause for our panelists here today. Thank you very much to our sponsors and our hosts, of course. But it was very great chatting with you all, and hope to continue seeing the industry grow.
Thank you.